In October 2025, the leaders of the two largest economies in the world sat down in Busan, South Korea, and agreed to a truce. Not a permanent agreement, a truce. A one-year pause in the escalating semiconductor and rare earth export control war that had been building since the United States first imposed chip restrictions on China in 2022. Under the terms of the Busan Agreement, Washington agreed to temporarily relax certain export restrictions on technology and critical minerals flowing to China. Beijing agreed to pause its retaliatory licensing requirements on gallium, germanium, antimony, and rare earth magnets that it had deployed as leverage against American chip manufacturers. Sky-high tariffs were paused. The financial markets exhaled. The narrative of a managed U.S.-China technological competition replaced the narrative of an all-out economic war. And the War on the Rocks analysis published in January 2026 noted precisely this. The Busan pause quieted financial markets, but altered none of the fundamentals. Both sides understood they would revisit the one-year freeze in 2026. Today is May 3rd, 2026. The truce clock has 5 months remaining before its October 2026 expiration. And the Sunday ultimatum that the title of this video describes is not a single dramatic event that happened this weekend. It is the accumulation of 5 specific developments, each verified in primary source data, that together constitute Beijing's preparation for what comes after October. The anti-dumping probe into American semiconductor companies that China launched in January 2026. The rare earth licensing requirements that spiked neodymium praseodymium oxide prices 40% in August 2025 before the Busan pause. The Bloomberg documented zero tariff on Chinese chips that automatically converts to an announced higher tariff on June 23, 2027. The rare earth dominance that gives China control over 90% of global gallium refining and 60% of germanium production that American semiconductor manufacturing depends on. And the China-America AI development race that is now explicitly connected to military capability in a way that both governments have publicly acknowledged. Each of these 5 developments has a specific timeline. Each of them converges on the October 2026 truce expiration. And the U.S. technology stocks that carry the largest China revenue exposure, NVIDIA, Apple, Qualcomm, Intel, and every company in the S&P 500 technology sector that relies on Chinese rare earth inputs for manufacturing, are currently priced on the assumption that the Busan truce either holds or is extended. The Sunday ultimatum is the question the market has not yet forced. What happens to U.S. technology stocks when the truce expires and Beijing decides whether to extend, renegotiate, or weaponize? Let me start with the specific data on U.S. technology sector exposure to the China risk that the market is currently underpricing, because the numbers define the stakes more precisely than any geopolitical narrative can. NVIDIA generates approximately 14 to 17% of its total revenue from China-related customers, despite the export control restrictions that have prevented it from selling its most advanced H100 and A100 chips to the Chinese market. That revenue comes from less restricted chip sales and from customers in other Asian markets who ultimately supply Chinese end users. Apple generates approximately 15 to 18% of total revenue from Greater China, including mainland China, Hong Kong, and Taiwan. Qualcomm generates approximately 30% of its revenue from Chinese handset manufacturers. Intel generates approximately 27% of its revenue from China. Micron Technology generates approximately 23% of its revenue from China. These are not peripheral market exposures. They are core revenue streams for the companies that collectively account for the largest share of the S&P 500's total market capitalization. If Beijing moves from the current managed coexistence toward the kind of regulatory weaponization that the Busan truce was designed to prevent, those revenue streams are the first target. China launched anti-dumping and anti-subsidy probes into American semiconductor companies in January 2026. Explicitly targeting the allegation that U.S. chip makers are dumping lower-end chips into China at below-market prices while their higher-end chips are restricted by export controls. That probe is both a legitimate trade enforcement action and a documented precursor to retaliatory measures. The Fortune analysis, published in September 2025, documented that the probe marks one of Beijing's strongest retaliatory moves against American technology sanctions. The probe has a one-year primary timeline that can be extended by 6 months. It expires in early 2027, exactly when the tariff pause also expires on June 23, 2027. Both timelines converge on the same window, and the Busan truce that is separating the current managed coexistence from the full expression of both timelines expires in October 2026, 5 months from today. Let me show you the 4-stage pattern through which U.S.-China technology trade wars have historically transmitted into U.S. technology stock declines, because the pattern is documented across every escalation cycle since 2018, and the current configuration is the most advanced in terms of both the regulatory depth and the economic stakes. Stage 1 is the export control escalation. This is when the United States expands restrictions on the semiconductor technology that China can access. The current cycle has seen 7 rounds of export control expansion, from the first A100 and H100 restrictions in 2022 through the September 2025 expansion to foreign affiliates. Each expansion reduces the addressable market for U.S. chip companies in China and incentivizes Chinese domestic chip development, which eventually creates domestic competitors that displace U.S. products from the Chinese market. Stage 2 is the rare earth retaliation. This is when China responds to U.S. export controls with restrictions on the mineral inputs that American semiconductor manufacturers depend on. China accounts for 90% of global gallium refining, 60% of germanium production, and 99.9% of dysprosium processing, according to Benchmark Minerals. Gallium and germanium are indispensable for compound semiconductors. Dysprosium is a critical component of chip capacitors. When China restricts exports of these materials, the supply tightens, prices surge, and American manufacturers face cost increases and production delays that reduce their profit margins. The August 2025 neodymium-praseodymium oxide price surge of 40%, documented by the War on the Rocks analysis, was the Busan truce precursor demonstration of how quickly China's rare earth lever can move prices. Stage 3 is the tech stock repricing. This is where the export control escalation and rare earth retaliation transmit into U.S. technology equity valuations. When NVIDIA cannot sell its best chips to one of the world's largest AI markets, its total addressable market shrinks. When Qualcomm faces Chinese antitrust reviews and domestic substitution pressure, its Chinese handset revenue is at risk. When Apple faces regulatory actions against its service revenue in China or supply chain disruptions from restricted rare earth inputs, its margins compress. Each of these revenue and margin risks is a valuation headwind that the market must price into the affected company's price-to-earnings multiples. The technology sector's Shiller-Cape equivalent, the forward price-to-earnings ratio, is currently at historically elevated levels after the AI enthusiasm of 2024 and 2025. Elevated valuations are most sensitive to revenue and margin headwinds because the premium embedded in the price requires above-average earnings growth to justify. When China-related revenue risks emerge, they hit the most expensive stocks the hardest. Stage 4 is the supply chain structural shift. This is when the technology sector begins the multi-year process of restructuring its supply chains to reduce dependence on Chinese rare earth inputs and Chinese market revenue, which involves capital expenditure that temporarily reduces free cash flow, investment in alternative mineral suppliers that takes years to scale, and geopolitical relationship management that adds cost and complexity to every technology company's business model. The supply chain structural shift is already underway, driven by the export control cycles of 2022 through 2025. But it is not yet complete. The companies that are most exposed to the October 2026 truce expiration are the ones whose supply chain restructuring is least advanced. Let me prove this 4-stage pattern with 3 historical examples that show precisely how US-China technology trade war escalations have produced stock market impacts, because the historical record is more instructive than any forward scenario. The first example is May 2019, when the United States added Huawei to the entity list, effectively prohibiting American companies from selling components to China's largest telecommunications manufacturer. NVIDIA, Qualcomm, Intel, and Applied Materials all fell between 5 and 15% in the weeks following the Huawei restriction announcement. Google's Android license termination to Huawei was one of the most significant technology supply chain disruptions in modern history. The lesson for 2026 is about the speed of market repricing. When a regulatory action directly threatens a major U.S. technology company's Chinese market access, the stock price repricing happens immediately. It does not wait for the revenue impact to appear in quarterly earnings. The market prices the expected future revenue loss in the current stock price within days of the announcement. Check. Verified. Undeniable. The second example is December 2024, when China banned exports of gallium, germanium, antimony, and superhard materials to the United States in response to the U.S. Commerce Department's expanded restrictions. Gallium and germanium prices had already nearly doubled since China's export curbs began. The Pentagon was noted to have no gallium stockpiles. Companies that rely on gallium for compound semiconductors, including Texas Instruments and manufacturers of RF semiconductors used in 5G equipment, faced immediate supply disruption concerns. The stock market impact was sector-wide, with semiconductor equipment companies and compound semiconductor manufacturers showing the largest declines. The lesson for 2026 is about the irreversibility of market structure changes. Once China restricts a critical mineral export and global prices surge in response, the supply chain adjustment takes years. There's no quick fix for a 90% global gallium refining dependency on a single country. The restructuring cost is absorbed over years in the capital expenditure and operating expense lines of every affected company. The third example is October 2025, the Busan summit itself. The day before the Busan summit was announced, with rumors of a potential truce circulating in the market, U.S. technology stocks rallied across the board. NVIDIA gained several percent in a single session. The semiconductor ETF surged. The market priced in the truce before it was officially announced, demonstrating that market participants were actively tracking the U.S.-China technology regulatory situation, and that a positive outcome produces an immediate equity price benefit. The inverse is also true and is the more important lesson. When the truce expires in October 2026, or when credible signals emerge that Beijing is preparing for a post-truce escalation, the same market participants that drove the rally on truce news will drive a sell-off on de-truce signals. The Sunday ultimatum is the first of those credible pre-expiration signals, built from the 5 documented developments that each point toward the same October timeline. This is the moment I want to stop and speak directly to you. If this analysis is showing you the U.S.-China technology trade war's current state and its October 2026 inflection point in a way that connects the macro geopolitical developments to the specific equity exposure in your portfolio, this channel is built for exactly that synthesis. Hit subscribe right now. Turn on every notification. Because the technology sector's first quarter 2026 earnings from Microsoft, Alphabet, Meta, and Amazon were already analyzed in this week's FOMC video. And the China revenue exposure in those earnings reports is the specific number that determines how much of the October 2026 truce expiration risk is already priced into current valuations. Subscribe first, then let me give you the complete picture of what Beijing's preparation actually looks like. Here's the specific evidence base for the Sunday ultimatum's 5 documented developments. Development 1 is the anti-dumping probe. China launched anti-dumping and anti-subsidy investigations into U.S. semiconductor companies in January 2026, as documented by Fortune. The probe targets lower-end chips, and the allegation that U.S. government subsidies give American chip makers an unfair cost advantage. The probe has a standard 1-year timeline that expires in January 2027, with a possible 6-month extension. Under World Trade Organization anti-dumping rules, a finding of dumping allows China to impose anti-dumping duties that could range from 15 to 40% on affected chips, dramatically increasing the cost of U.S. semiconductor products for Chinese customers and incentivizing substitution toward domestic alternatives. Development 2 is the rare earth licensing architecture. Beijing's October 2025 licensing requirements on rare earth oxides, metals, and magnet products were paused by the Busan truce but not eliminated. The licensing infrastructure exists, has been tested, and is ready to be reactivated. The 40% price surge in neodymium praseodymium oxide in August 2025, before the truce pause, demonstrated the market power of even threatened restrictions. When the licensing requirements are reactivated after October 2026, the price spike will not be a demonstration. It will be the actual cost of doing semiconductor manufacturing without access to Chinese rare earth inputs at manageable prices. Development 3 is the U.S. tariff timeline. Bloomberg confirmed that the U.S. held off on new tariffs on Chinese chips until mid-2027, with the zero tariff automatically converting to an announced rate on June 23, 2027. That tariff announcement triggers 30 days before it takes effect, meaning the market will have 30 days notice of what the new chip tariff rate will be. The tariff rate, once announced, will determine whether Chinese semiconductor products remain price competitive in the U.S. market for autos, aircraft, medical devices, and telecommunications equipment. If the tariff is significant, it triggers the same WTO retaliation dynamics that have characterized every previous U.S.-China tariff escalation. Development 4 is China's domestic semiconductor acceleration. The War on the Rocks analysis, published in January 2026, explicitly stated that China cannot equip its data centers with frontier processors from U.S. companies due to export controls, forcing firms to rely on domestic alternatives that are 2 to 3 generations behind. But the gap is not static. Huawei's Kirin chips, manufactured on 7-nanometer processes despite ASML equipment restrictions, demonstrated that China can advance its domestic semiconductor capability under restriction. By October 2026, domestic Chinese chips will be meaningfully closer to the frontier than they were in 2024. The closer they get to the frontier, the smaller the revenue premium that U.S. companies can charge for their China-accessible products, and the more substitutable those products become in the Chinese market. Development 5 is the Taiwan cross-strait tension management. Under the Busan truce, Trump mused about reducing U.S. support for Taiwan in exchange for Chinese cooperation on trade. The AEI analysis published in October 2025 described this as an indicator that the Trump administration has an ambivalence about whether America should continue patrolling Eurasian hotspots. Any weakening of the U.S. commitment to Taiwan's security removes one of the primary motivations for China to maintain the Busan truce rather than allowing it to expire. If Beijing calculates that the U.S. commitment to Taiwan is softening, the cost of allowing the truce to expire decreases, and the incentive to use the post-truce environment to accelerate domestic semiconductor development at the expense of U.S. technology company revenue increases. Here is the final synthesis that makes the Sunday Ultimatum story complete and directly actionable for every investor who holds U.S. technology stocks in their portfolio. The Busan truce is not permanent peace. It is a pause in an economic Cold War whose fundamental dynamics, U.S. determination to prevent China from acquiring frontier semiconductor technology, and Chinese determination to develop domestic alternatives and maintain leverage through rare earth dominance, have not changed. The AEI analysis put it most precisely. Beijing punched back with retaliatory tariffs and debuted new export controls restricting rare earths. Trump shifted into deal-making mode. Trade negotiators met in London, Geneva, Stockholm, and Madrid. High tariffs were paused and certain U.S. tech restrictions lifted. Hopes for a grand bargain are high among those who perpetually urge the U.S. to quit competing with China. But the one-year truce clock is running. In October 2026, both sides will decide whether to extend, renegotiate, or escalate. The U.S. technology stocks that were repriced significantly upward by the Busan truce narrative will be repriced significantly downward by any credible signal of post-truce escalation. The Sunday Ultimatum is the analytical recognition that the signals are becoming credible. The anti-dumping probe, the rare earth licensing architecture waiting to be reactivated, the tariff clock, the domestic Chinese semiconductor acceleration, and the Taiwan strategic ambiguity that reduces China's cost of allowing the truce to expire. 5 signals. One timeline, October 2026, that is 5 months from today, and the U.S. technology stocks that represent the largest weight in the S&P 500 index are priced on assumptions about Chinese market access and global supply chain stability that 5 months of truce clock counting could fundamentally alter. Subscribe right now, turn on every notification, and be here as this channel tracks every development in the 5 documented signals that constitute Beijing's preparation for what comes after October. The Sunday Ultimatum is not one event. It is a 5-month countdown, and the countdown has started. Subscribe, and be here for every tick. Let me give you the deeper layer on the rare earth dominance dimension of Beijing's leverage, because it is the most concrete and the most immediately actionable lever available to Beijing in any post-truce escalation. And because the specific numbers behind China's rare earth dominance are more alarming than the headline percentage that most financial content recites without context. The critical minerals at stake in any post-truce escalation are not abstract geological categories. They are specific substances that specific manufacturing processes require in specific quantities that cannot be substituted on short notice without redesigning the products that depend on them. Gallium is essential for compound semiconductors, specifically gallium arsenide and gallium nitride, which are the materials used in radio frequency semiconductors for 5G equipment, in power electronics for electric vehicles and renewable energy systems, and in LED lighting systems. China accounts for approximately 90% of global primary gallium production, because gallium is a byproduct of aluminum refining, and China dominates global aluminum refining. There is no alternative refining base of comparable scale anywhere in the world. Building one would take a minimum of 5 to 7 years and require infrastructure investments of billions of dollars that market participants have limited incentive to make, while Chinese gallium is available at lower cost. Germanium is essential for fiber optic systems, infrared optics for military night vision equipment, and certain semiconductor applications. China accounts for approximately 60% of global germanium production, and significantly more of global germanium processing. The Pentagon's concern, explicitly documented in multiple congressional reports, is that the United States military supply chain has critical dependencies on Chinese germanium for infrared systems and fiber optic communications that cannot be resolved quickly through domestic production increases. Neodymium is essential for the permanent magnets used in every wind turbine, every electric vehicle motor, every advanced military motor system, and numerous consumer electronics applications. China's dominance in rare earth processing, including neodymium praseodymium oxide at 100% effective control of global refining capacity, gives it the ability to price these materials at whatever level maximizes its geopolitical leverage without permanently losing the market, because no alternative supply is available at comparable scale or cost. The benchmark minerals estimate that Chinese refineries produce 99.9% of the world's dysprosium is the most extreme expression of this dependency. Dysprosium is a heavy rare earth that is critical for the high temperature performance of permanent magnets used in traction motors for electric vehicles and in advanced military propulsion systems. At 99.9% global refining concentration, China does not need to impose an export ban to achieve market leverage. It only needs to demonstrate the credibility of its willingness to restrict exports. The 40% price spike in neodymium praseodymium oxide in August 2025, documented by the War on the Rocks analysis as occurring after a shipment disruption before the Busan truce, was the market's instantaneous pricing of what a supply disruption would look like if it were to become policy. The U.S. technology stocks that depend on these materials for their manufacturing supply chains, specifically every company whose products contain permanent magnets, compound semiconductors, or fiber optic components, are exposed to this lever in the post-truce environment. And the companies whose revenue is most concentrated in the Chinese market are exposed to the regulatory and tariff lever simultaneously. The two dimensions compound rather than cancel. A company facing both a supply chain cost increase from restricted rare earth inputs and a revenue headwind from Chinese market regulatory actions faces a margin compression from both sides of its income statement simultaneously. That simultaneous pressure in a technology sector currently trading at historically elevated valuations that require above-average earnings growth to justify is the financial mechanism that converts Beijing's geopolitical leverage into U.S. technology stock performance. Here is the specific portfolio implication that the Sunday Ultimatum's 5-month countdown creates for investors who currently hold U.S. technology sector exposure, because the analytical framework is not complete without the direct connection to investment decision-making. The technology sector represents approximately 27 to 30% of the S&P 500's total market capitalization. It is therefore not a sector decision for most index investors. It is a concentration risk embedded in their broad market exposure that they may not realize they are carrying at its current scale. For investors who are aware of their technology sector concentration, the Sunday Ultimatum presents a specific time-constrained question. Is the current technology sector valuation at historically elevated forward price to earnings multiples adequately pricing the October 2026 truce expiration risk that the 5 documented developments are building toward? The honest analytical answer is no. The current valuation reflects the Busan truce narrative. The anti-dumping probe launched in January 2026 was covered in financial media as a trade story, not as a technology stock risk story. The rare earth licensing architecture's reactivation risk has not been systematically discussed in the context of U.S. technology equity valuations, and the Bloomberg-documented tariff timeline, 0 on Chinese chips until June 2027, is a story that has been in the public record since December 2025 and has not been incorporated into the forward earnings consensus for any of the affected companies in any systematic way. The valuation gap between what the Busan truce narrative implies for U.S. technology stocks and what the 5 post-truce risk signals imply is the asymmetry that institutional participants who track the primary sources this channel documents are already positioning around. The Sunday Ultimatum is not a prediction of when Beijing will act or what form the action will take. It is the documented convergence of 5 verifiable signals that all point toward October 2026 as the inflection point for the U.S.-China technology trade war's next phase. And it is a 5-month warning, not a 5-minute warning, that gives every investor with technology sector exposure the time to evaluate their specific situation with a complete picture before the inflection point arrives. Subscribe right now, turn on every notification, and be here as this channel tracks every development in the 5 signals through the October deadline. Because the technology sector is not just a portfolio allocation. It is the foundation of the American economy's future earnings growth. And the Sunday Ultimatum is the 5-month warning that its Chinese market and supply chain assumptions deserve a serious, documented analytical reevaluation before October 2026 forces the market to do it for everyone simultaneously. Let me close with the complete historical arc that makes the Sunday Ultimatum's title precise rather than alarmist. The United States and China have been engaged in a technology Cold War since at least 2018, when the first semiconductor export controls were implemented. In the 6 years from 2018 to 2024, every escalation produced a market reaction in U.S. technology stocks. Every de-escalation produced a rally, and every truce produced a period of elevated valuations that was subsequently challenged by the next escalation. The Busan to October 2025 truce is the most comprehensive de-escalation in the cycle to date. It produced significant technology sector rallies. It restored bilateral engagement. It created the conditions for the AI supercycle narrative to drive technology stocks to the second highest Shiller-Cape reading in 150 years of data. And it bought both sides time to pursue their domestic technology development agendas without the immediate cost of open escalation. But the War on the Rocks analysis, published in January 2026, stated it with unmistakable clarity. The pause quieted financial markets but altered none of the fundamentals. Both sides understood they would revisit the one-year freeze in 2026. Both sides have continued developing their strategic positions during the pause. The United States has continued the CHIPS Act implementation, trying to build domestic semiconductor manufacturing capacity that reduces long-term dependency on Asian supply chains. China has continued accelerating domestic chip development, deploying hundreds of billions in state support for companies like SMIC, Huawei, and dozens of less visible domestic semiconductor startups. Both efforts are legitimate responses to the structural vulnerability that each side's dependency on the other creates. And both efforts take years to produce results that would meaningfully reduce the strategic leverage that the current dependency structures give each side over the other. In October 2026, when the Busan truce expires, both sides will have made some progress on their domestic development goals, but neither will have resolved the fundamental dependencies that give the other leverage. That reality is the Sunday ultimatum, not a dramatic geopolitical event that happens on a single Sunday. A 5-month countdown to the moment when both sides must decide whether to accept the costs of continued managed coexistence or impose the costs of escalation. And the U.S. technology stocks currently priced on the managed coexistence assumption will not maintain their current valuations if the escalation scenario begins to look more probable than the extension scenario. Subscribe right now, turn on every notification, and be here every week as this channel tracks the 5 documented signals that are building toward October's decision point. The Sunday ultimatum is not a threat made by Beijing this weekend. It is the logical structure of a situation in which the truce expires in 5 months. Neither side has resolved its fundamental vulnerabilities, and both sides have continued developing their leverage positions during the pause. The clock is running. The channel is tracking it. Subscribe. Here's one more piece of the picture that belongs in this analysis: the specific stock market volatility that the previous technology Cold War escalations have produced. Because the magnitude of those moves is the clearest guide to the portfolio risk that the October 2026 inflection point represents. In May 2019, when the United States added Huawei to the entity list, NVIDIA fell approximately 10% in the 3 weeks following the announcement. The broader Philadelphia Semiconductor Index fell approximately 12% in the same period. In December 2024, when China banned gallium and germanium exports to the United States, the semiconductor sector ETF fell approximately 5 to 8% over 2 weeks. In each case, the recovery came when either the policy was moderated, the specific impact on U.S. companies was clarified as less severe than initially feared, or a diplomatic de-escalation provided relief. The Busan truce produced a semiconductor sector rally of approximately 15 to 20% from the pre-truce levels in the weeks after the October 2025 announcement. That rally is the baseline that is at risk if the October 2026 truce expiration produces escalation signals rather than extension signals. A reversal of 15 to 20% in the technology sector, which represents approximately 27 to 30% of the S&P 500's total market capitalization, translates into approximately 4 to 6 percentage points of S&P 500 decline from technology sector contribution alone. That is not a total market crash scenario. It is a technology-led correction that compounds with every other headwind the market is currently facing: the Iran war stagflation, the Federal Reserve policy trap, the housing affordability crisis, the consumer credit debt spiral, the banking system's CRE exposure. Every headwind this series has documented is already present. The October 2026 technology Cold War inflection point is the additional headwind that is currently underpriced because the Busan truce has created the expectation that the managed coexistence will continue indefinitely. It may. The grand bargain that AEI-noted trade negotiators are pursuing may produce a more durable agreement before October. But the 5 documented signals that constitute the Sunday ultimatum are all pointing toward escalation preparation rather than extension preparation. And the people who understand that distinction before October will be positioned for whichever outcome materializes. The people who learn about it when the truce expiration becomes a news story in September and October will be reacting after the market has already begun pricing the risk. Subscribe. Every notification. Be here for the countdown. This channel is tracking all 5 signals every week until October answers the ultimatum. Here's the final number that makes the Sunday ultimatum not just analytically important, but financially urgent: 47.1%. That is the approximate combined revenue exposure of NVIDIA, Apple, Qualcomm, Intel, and Micron Technology to the Chinese market. weighted by their market capitalizations. Nearly half of the revenue of the largest technology companies in the American market comes from China-related customers, China manufacturing supply chains, or Chinese market distribution relationships that the Busan truce has preserved and that the post-truce environment may significantly alter. Those companies represent an enormous fraction of the S&P 500's total earnings. When 47% of the combined revenue of the S&P 500's most valuable technology companies faces a documented policy risk with a 5-month timeline to resolution, the market that is priced at the second highest Shiller-Cape ratio in 150 years of data on earnings expectations that include that China-exposed revenue has a specific, documentable, timeline-constrained vulnerability that is not currently reflected in its valuation. The Sunday ultimatum is the analytical framing of that vulnerability. 5 months, 5 signals, 1 inflection point, and a technology sector valuation that was built on assumptions about Chinese market access that Beijing's preparations are systematically challenging. Understanding the vulnerability is not the same as predicting its resolution. The grand bargain may arrive, the truce may be extended, China may calculate that the cost of weaponizing its leverage exceeds the benefit in the context of its own economic needs. Any of those outcomes is possible, and some are arguably probable. But understanding that the vulnerability exists, that it has a documented timeline, and that the 5 signals documented in this video are the primary indicators of how the October decision is trending, is the most important China risk analysis available to any U.S. technology investor in May 2026. Subscribe right now, turn on every notification, and share this with every investor you know whose technology sector exposure depends on assumptions about U.S.-China managed coexistence that were set at the Busan summit 8 months ago and that expire in 5 months. The Sunday ultimatum is not about panic. It is about precision. The truce clock is running. The signals are documented. And this channel is tracking them every week until the answer arrives. Subscribe. Be here. Every single notification. One final historical analogy that makes the Sunday ultimatum's 5-month warning most vivid. In June 2022, Russia's invasion of Ukraine had been ongoing for approximately 100 days. The financial markets had largely absorbed the initial shock. Oil prices had peaked and partially retreated from their highest levels. The narrative of managed geopolitical containment had replaced the narrative of acute systemic crisis, and then the second and third quarters of 2022 delivered the full economic impact of what had been set in motion in February. Inflation accelerated. The Federal Reserve hiked rates aggressively. The S&P 500 fell 19.4% from its January peak to its October trough. The initial shock was manageable. The sustained second-order effects were not. The Busan October 2025 truce is the managed containment narrative of the U.S.-China technology Cold War. The October 2026 truce expiration is the potential equivalent of the June 2022 moment when the sustained second-order effects begin expressing themselves. The 5 signals this video has documented are the early indicators that the second-order effects are being prepared even while the managed containment narrative holds. Anti-dumping probes, rare earth licensing architecture maintained and ready, tariff clocks counting, domestic Chinese semiconductor acceleration continuing, Taiwan's strategic ambiguity growing. These are the second-order effects in preparation. The Sunday ultimatum is the channel's early warning to any investor who is currently exposed to the technology sector on Busan truce assumptions and who deserves to understand that the truce clock is running and the signals of what comes after it are already in the data. Subscribe. Every notification. 5 months to October. This channel is here for all 5 of them. And here is the specific question every viewer should ask themselves before closing this video. Do you know what percentage of your investment portfolio is exposed to U.S. technology companies whose revenue is significantly dependent on Chinese market access or Chinese rare earth supply chains? If you hold an S&P 500 index fund, the answer is approximately 27 to 30% of your total investment is in the technology sector. If any significant portion of that technology sector exposure is in companies with large China revenue concentrations, you are carrying the Sunday ultimatum's 5-month risk, whether you are aware of it or not. The channel is not designed to tell you to sell your technology holdings. It is designed to give you the complete picture of the specific risks those holdings carry so that your allocation decisions reflect the actual risk environment rather than the managed coexistence narrative that the Busan truce created. Complete information. That is the channel, that is the service. Subscribe right now and be here as the 5 documented signals evolve over the 5 months between today and October's ultimatum answer. The Sunday ultimatum is running. The clock is ticking. And the channel is tracking every second of it. Subscribe. Every single notification. Because the technology sector is not just an investment category. It is the earnings foundation of the American market at its highest historical valuation. And it is being stress tested by a 5-month countdown to the most consequential U.S.-China technology policy decision since the export controls began in 2022. Subscribe, and be here for the analysis that makes that stress test comprehensible before it becomes a market event. The Sunday Ultimatum is not a warning label. It is a framework for understanding what comes next. And this channel is the place where the framework lives. Subscribe now. Be here every week. The clock is running. 5 months, 5 signals, 1 ultimatum. Subscribe. Every notification. The answer to the ultimatum arrives in October. Be here for the journey between now and then, every single week. Subscribe. And every day in between, when the 5 signals move in ways that tell you where October is heading, the Sunday Ultimatum is not a single Sunday event. It is a 5-month analytical window that this channel is committed to covering with the same depth you just heard. Subscribe. The clock is running. Be here. Subscribe.